Most people think that they have plenty of time to start investing, but what if I told you that starting at 35 instead of 25 could cost you $1 million or more? Now, if you don't believe me, it absolutely can, and today my AI assistant Tiara and I are going to show you how. So Tiara, how can we start this one?
Let's get into starting early versus starting late.
All right, let's break this down and see why starting to invest at 25 is such a game changer compared to waiting until 35. Well, it all comes down to the power of compound interest. Basically, earning returns on your returns and how much time you give it to work its magic. Now, this is kind of hard to picture, so let's take a second here to give you a simple example that's, well, kind of mind-blowing. And before we get into that, I want to mention that a little later in this video, I'm also going to share my thoughts on a really dumb investment mistake that people make that really needs to be avoided at all costs. And unfortunately, it's also relatively common, but more on that in a little bit. Okay, so back to the example. So imagine two people, Alex and Taylor. Alex starts investing $5,000 a year at age 25 and completely stops contributing at age 35. So they only invested for 10 years. Now, Taylor, on the other hand, waits until the age of 35 to start investing the same $5,000 a year, but keeps going until the age of 65, investing a total of 30 years. So that's simple enough, but here's where it gets crazy. Let's assume that both earn an average annual return of 7% compounded yearly. By the time they both reach the age of 65, Alex will have invested just $50,000 total, 5,000 times 10 years, but that money grows over the next 30 years without any additional contributions, ending up at $563,000. Now, Taylor, on the other hand, invests $150,000 total, so $5,000 times 30 years. But because they started later, their investments grow to only about $505,000 by age 65. So even though Taylor invested 3 times as much money as Alex actually ends up with more money simply because they started earlier and gave compound interest more time to work its magic. Plus, they only invested for 10 years versus 30 years. That's not a bad deal. So the takeaway here is, well, before I get to that, first off, make sure that you subscribe to the channel so that you build up good investing habits and help support me to try to support my own family with this channel, which I obviously do appreciate.
Do it now.
But the other big takeaway is that, time really is your secret weapon when it comes to building wealth. So the earlier that you start investing, even if it's just small amounts, the bigger that your results can be in the long run.
Because let's face it, humans, if you can afford $12 lattes and overpriced brunches, you can scrape together a few bucks to not die broke.
A little rude, Tiara, but not necessarily wrong.
And he caused the inflation.
So, Tiara, let's move on. What's next here?
Let's get into the foundation of compound interest.
All right, well, let's talk about one of the most important principles in investing, which led to the outcome of our example between Alex and Taylor earlier, which is compound interest. Okay, so in simple terms, compound interest is when your money earns returns, and then those returns start earning returns too. So this is like rolling a snowball down a hill that just keeps getting bigger and bigger, only the snowball is basically your original investment. Okay, so here's a simple way to think about it. So imagine that you invest $1,000 and earn a 7% return in the first year. That's $70 in growth, and so now you have $1,070. Now in the second year, you don't just earn 7% on the original 1,000, you also earn 7% on that extra $70 from the last year. So that ends up being $74.90 in growth, which will bring your total now to $1,144.90. Now each year, the amount of money your investment earns gets bigger because you're earning interests on both your original investment and the growth from the previous year. Now, in the early years, it might feel like your money really isn't growing much, but over decades, the compounding effect accelerates dramatically and really changes things. So let's go back to the Alex and Taylor example from earlier to connect this idea. So Alex started investing at 25 years old and gave his money 40 years to grow. So there was 10 years of contributions and 30 years of compounding. Taylor started at 35 and only gave their money 30 years to grow. So there was 30 years of contributions and really 20 years of compounding. Those extra 10 years for Alex made all the difference because, compound interest, it had more time to multiply their investments. So how do you take advantage of this? Well, start investing as early as possible, even if it's just small amounts, because time is what makes compound interest so powerful, not necessarily investing large sums of money at a time.
Good examples, Ron. Want me to get to the next part?
Sure, Tiara, shoot.
How about we discuss investing strategies?
All right, well, now that we've seen how starting early can make a massive difference, let's go ahead and talk about how to actually get started. So the good news here, you don't need to be a financial expert or have a ton of money to begin investing. So here are a few really simple and beginner-friendly strategies to help you take advantage of compound interest. And as a reminder, before I get into it, this is not financial advice and it is for informational purposes only, so make sure that you do your own research before investing. I always have to say that, just so that we're clear. So start with a retirement account. So one of the easiest ways to start investing is through a retirement account, like a 401k or an IRA, which is an individual retirement account. If your employer offers a 401k, take advantage of it, especially if they match your contributions, because that's effectively free money at the end of the day. Now, if you don't have access to a 401k, then open an IRA. So a Roth IRA is especially great for younger investors because your money will grow tax-free and you won't pay taxes when you withdraw it later in retirement. So as an example, if you invest just $200 a month at age 25, earning a 7% return, you could end up with over $500,000 by 65. Oh, and just a reminder, if you're still looking to hear about that really, really dumb investment mistake that I mentioned earlier in the video here, stay tuned. It's coming soon, I promise.
That's what he said.
Next would be investing in index funds or ETFs. So if you're wondering where to invest your money, index funds and ETFs are excellent options for beginners. So these are baskets of investments that track the overall market, like the S&P 500. But even more importantly, they're low cost, meaning they have much lower fees compared to actively managed funds. And they are also diversified because your money is spread across hundreds of companies, reducing your overall risk. So for example, instead of trying to pick individual stocks, which can be risky, and I'd actually advise against it, you could invest in an S&P 500 index fund and own a small piece of 500 of the largest companies in the United States instead. Next is to automate your investments. So consistency is key when it comes to building wealth over time. So what you want to do is set up automatic contributions so that part of your paycheck, it goes straight into your investment account every single month without fail. So this term, it's really known as dollar cost averaging, and it's something that even the best investing minds advocate for all the time. By automating this, you remove the temptation to spend that money, and it keeps you on track for your goals without really even having to think about it. Now, another big mistake is that, you don't want to wait for the perfect time. So a common mistake that people make is trying to time the market. So they are waiting for prices to drop or for things to kind of feel just right. But that's a huge mistake. The truth is that the best time to start investing was yesterday. The second best time is today. The earlier you start, the more time compound interest has to work for you. So long as you stick to the dollar cost averaging principle, you'll do well. And a pro tip here, if $5,000 a year, like in these examples, it sounds overwhelming to you, well, remember that even small amounts really do add up over time. So the bottom line is to pick an investment strategy that works for you and stick with that. All right, so what's next, Tiara?
Let's get into common pitfalls people make.
Okay, that works. So starting early is important, but it's just as crucial to make smart decisions along the way. Now, we've already discussed the importance of not trying to time the market and dollar cost averaging, but there's more than that. So let's list out some of the common pitfalls to avoid. And we'll start with not investing enough. So one of the really common mistakes is underestimating how much you need to invest. So while starting small is better than not starting at all, you should really aim to increase your contributions as your income grows. Now, a good rule of thumb here is to invest at least 15% of your income if that's possible. Now, if that feels like too much, right now, and it's like, I can't do that, we'll start with 5% or even 1% and increase gradually as you can afford it. Now, many retirement plans with employers, they let you set up automatic contribution increases. So it kind of happens without you even noticing. And I definitely recommend that if you can. And one little thing before we move on here is when you think about investing, don't think in terms of dollar amounts. Instead, think of percentages of your income. That way, if you say that you're going to invest, 5% of your income, it'll scale up and down as your earning potential changes with time, and you'll have a general rule to always stick to. And the next pitfall is letting fear stop you. So the stock market, it can be very intimidating, especially when you hear about the crashes and downturns in the news.
What in the world is happening on Wall Street?
It was the worst day on Wall Street since the crash of 1987.
Just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
But here's the thing, investing is a long-term game. The market will have ups and downs, but historically, it has always trended upward over time. In fact, over the last 100 years, the average stock market return is a very solid 10% return. So here's an example of when fear kind of, steered people the wrong way. So during the 2008 financial crisis, many people panicked and they pulled their money out of the market. But those who stayed invested recovered their losses and saw significant gains the following years. The key here is to stay calm and trust the process, knowing that the stock market will come back because historically, it always has. Now, one other pitfall that's very easy to overlook is ignoring fees.
Because nothing says financial genius like accidentally donating your returns to fund managers.
See, many times I disagree with Tiara, but she gets it here. Now, fees, they might not seem like a big deal at first glance, but they can eat away at your returns over time. So always pay attention to expense ratios, which is the cost of managing a fund, and avoid high fee investments when possible. So to show you just how important this is, as an example, let's say that you invest $100,000 in two different funds, one with a 0.1% fee and one with a 1% fee. Now, over 30 years with a 7% return, the fund with the lower fee could leave you with tens of thousands more dollars than the higher fee fund. Now, if you're wondering what I use and what a lot of people recommend, it is Vanguard funds because they have those low fees and expense ratios. But of course, do your own research and choose what you're most comfortable with. And another pitfall? Well, this is the really dumb investing mistake that I mentioned earlier in the video that I think people should avoid at all costs. And that's people that are trying to get rich quick while investing, which is usually done by investing in penny stocks. And that, well, it's not really a great strategy. And this video right here will actually show you why. And if that video isn't for you, check out this other video instead. But before you go, please make sure to subscribe to the channel to unlock financial success one AI chat at a time.